So what's a debt to income ratio and how does it affect your ability to obtain a mortgage? I'm Brent Altilio, your mortgage teacher. Today I'm going to talk to you about your debt to income ratio, which is basically your monthly payments on your debts divided by your monthly income. So there's some things that qualify in your debt to income ratio and some things that don't, and that's what we're going to talk about today, because in order to get a mortgage, there's different percentages of debt to income ratio that you can have to qualify for a mortgage. So first of all, things that do count on your debt to income ratio. Obviously, your new mortgage. So whatever that mortgage payment is going to be, your principal, your interest, your insurance, your tax bill, and any HOA fee that might be associated with that property is going to be counted towards your debt to income ratio. Another thing, and this is a big thing, is car payments. Car payments count against your debt to income ratio. One exception is that if you have less than 10 months left on your car payment, we can exclude those payments. However, if it's a lease, we can't exclude those payments because we assume that you're going to be moving into another lease. So car payments count unless you have 10 months or less on that car payment. Another thing that counts is your credit card payments, but the minimum payment. So if your minimum is $30, that's all that counts against your debt to income, even if you're paying more than that every month. Here's a big one, student loan payments. And I know you're thinking, well, my student loan payment right now is zero because it's a federal loan, and ever since COVID, I don't have to make payments. Well, we still have to calculate a small percentage of your total remaining balance on student loans and count that towards your debt to income ratio. And last but not least, a big one, child support or alimony. So if you're paying those and it doesn't show up on your credit report, you do need to let us know that you are making those payments. We have to count that towards your debt to income ratio. Here's things that don't count on your debt to income ratio. First of all, any utilities you're paying. So your power bill, your water bill, your heating bill, things like that don't count on debt to income ratios. Your cable, your cell phone doesn't count. Car insurance, health insurance, that doesn't count on your debt to income. One caveat in all these. If you haven't made payments and now these things are in collections, we will see that, and that does count towards your debt. Another thing that doesn't count, medical debt, medical payments that you're making as long as it hasn't gone to collections. That doesn't count towards your debt to income ratio. Money that you use for food or fun, spending money or hobbies doesn't count as part of your debt to income ratio. So that is free and clear. One last example I'm going to share with you, and it might be a little bit funny, but I know the holidays are coming and you might really be excited about getting the kids a new puppy. Well, buy the puppy outright. Don't finance the puppy, because if you've signed everything for a mortgage and we go to check your final statements before the closing date and you finance that puppy, it might put you over the debt to income threshold. We've seen it happen. Just adopt a puppy. Don't buy one. Right, Maddie? Right, Maddie? I'm Brent Altilio, your mortgage teacher. Have a great week.